It's so over. Bitcoin is crashing. The top is in. 2026 is going to be a bear market. Yada, yada, yada. Stop listening to this nonsense because the people saying this are looking at the Bitcoin market through an outdated framework. And in this video, I'm going to dissect what's really going on, what you need to be looking at, and why you should be bullish on Bitcoin right now. So, we're going to go through a ton of different charts and I'll break everything down step by step. Starting with recent price action, of course, Bitcoin has fallen precipitously over the past few weeks. Early October, Bitcoin peaked at an all time high of around $125,000. Friday, we went as low as 94K. And at the time of recording on Saturday, November 15th, Bitcoin is at around $95,000. But the problem most people have right now is they're viewing the market through an outdated framework. Bitcoin, yes, historically has gone on these 4-year cycles, and we'll put this back in log scale, where every 4 years it has a parabolic bull market going up an order of magnitude, followed by a nasty bear market with a 75% drawdown. Historically, this has been true. Nobody's denying that. In 2013, Bitcoin went on a massive run, 75% drop. 2017, same thing. 2020 and 2021, same thing. But the problem is that the market is not the same in 2025 as it was historically. Let's zoom back in and let's look at Bitcoin's price action over the past 2 years, roughly. BlackRock filed for a Bitcoin ETF in July or June rather of 2023, and the ETF began publicly trading in January of 2024, and this changed everything. The Bitcoin market is not the same. It's fundamentally different. It has a fundamentally different source of demand now than it did during the 4-year cycle era. And so I'm going to break down a bunch of charts in this video showing you why the outdated framework is going to leave you high and dry. If you're trying to trade Bitcoin based on this 4-year cycle idea, you're selling Bitcoin now, you plan to buy it back a year from now at lower prices, you may be left in the dust. And this is not what the smart money is doing right now. Simple framework here. If you look at Bitcoin's price action post ETF, so right around here, January of 2024, it's been a brag for some people. If you're expecting a massive run up 10x in 12 months, it just hasn't happened. It has been dominated by periods of consolidation. We've gotten bull runs in February and March of 2024. Bitcoin went up from 40K to a high of 70K before consolidating for 6 months. In November of 2024 into December, Bitcoin went from 60K up to 100K, and then it has been consolidating between 100K plus or minus 10% for the past year. And this is incredibly bullish, but if you're stuck looking at the market through the old framework, you're thinking we've topped, I'm going to sell, I'm going to try to buy back in lower, go into a bear market. You're thinking about this all wrong. So, let's look at the new framework. The new framework is cyclicality after the Bitcoin ETF. This is the new framework we're looking at because this cyclicality is not driven by halving cycles. The impact of the 2024 halving was so negligent. The amount of Bitcoin that entered circulation daily went from 900 to 450. This has very little marginal impact on the supply demand balance as it stands. What's driving these news cycles, and you can see it here in this chart, and we'll look at some more charts throughout the video, is the flows of Bitcoin holders, so long-term holders moving coins around, and then fiat liquidity. And we'll dissect some of that here in this video, but you can see somewhat of a new cycle beginning to form. During these periods of consolidation, Bitcoin's realized cap increases as new market participants are buying at higher prices. Ultimately, a local bottom is formed, and then Bitcoin takes a stair step higher. So, consolidation, stair step higher has been the name of the game since the ETFs were launched. And again, you got to be looking at it through the new framework because the market, whether or not you like it, whether you appreciate the suit coiners, it's fundamentally different. And so, you need to interface with the market as it is, not the way you wish it was or the way it used to be. So we can see here when looking at Bitcoin's market cap and realized cap and the ratio between the two, you can see that this has denoted two previous local bottoms during this post ETF era. when the MVRV ratio goes beneath 1.8. So what this measures is the amount of capital that's been put into the network, this orange line here, realized cap, versus Bitcoin's market cap, the black line here, which is a reflection of Bitcoin's price. When these metrics are closer together, Bitcoin is undervalued. When they separate, Bitcoin is arguably overvalued. And that ratio is measured here with this green line. So you can see previous local bottoms during the ETF era. We've seen MVRV ratio reach under 1.8. That's where we're at now. Don't take one metric as gospel. We're going to look at the entirety of the situation, the full scope. But here's one anecdotal or supplementary piece of evidence, and we're going to continue to dive into some more charts that show very similar trends. So again, we have the percent of supply in profit. So how much of the 21 million Bitcoin are in profit? Because one of the fascinating things about on-chain data, you can see how many coins move at what time, and you can track that with the Bitcoin price. So effectively every coin's cost basis on the network. And previous local bottoms during this ETF era, about 75% of the coins were in profit. Obviously, at an all-time high, it's going to be 100%. And so you can see that times up with new all-time highs, 100% of the coins are in profit, dropping down to 75% during these previous local bottoms, as you can see here with the red lines pointing to the drops. That's where we're at again. So another piece of data that points to the fact that we may be at a local bottom right here. Now, I mentioned at the start of this video the new catalyst for Bitcoin's cyclicality, which is this new cyclicality post ETF, not the 4-year having cyclicality of old, but this new form of cyclicality. It's driven by fiat liquidity and the movement of coins on chain. You can very simply think about this as demand and supply, right? The more dollars, the more fiat liquidity that is in the system, that's more potential demand for Bitcoin. Inversely, we can see on-chain flows and get a pretty good estimate of Bitcoin's supply side in terms of how much supply is actually liquid, which holders are willing to sell, how many coins they have, etc. One more component of demand is, and I won't elaborate on it too much in this video, but it's the actual vehicles for moving the fiat liquidity into Bitcoin. So simplest example is a Bitcoin ETF. That's a bridge that allows new fiat liquidity to buy Bitcoin. Bitcoin treasury companies, a bridge that allows new fiat liquidity to buy Bitcoin. So that interfaces with the demand component somewhat, but primarily we're looking at fiat liquidity. And what's a telltale indicator that fiat liquidity is going to increase? Interest rates being dropped, obviously, right? Because it becomes cheaper to borrow. We're on a fractional reserve banking system, lower rates, more borrowing, more liquidity in the system. The Federal Reserve is starting to cut rates yet again. We are very likely going to get a new Federal Reserve chairman in 2026. And so whoever this is going to be far more aligned with Donald Trump and his mission to lower interest rates than Jerome Powell, who has pretty much stood his ground. The Federal Reserve likes to posture itself as wholly an independent entity. We know that's not the case. There are obviously political pressures and banking pressures on the Federal Reserve, so they're not independent, but they like to pretend to be. Powell's done a somewhat okay job at that, but that facade is going to be entirely thrown out the window come with the next Federal Reserve chairman. You can see in 2020 when interest rates plummeted to zero overnight, Bitcoin went on a massive run following suit. Even last year in 2024, when this cutting cycle initially began, Bitcoin rallied in the months to follow. This is not going to be any different. We're getting interest rate cuts again. There's no reason to think that this is bearish. And you have to understand precisely the reason why this is not bearish. Why is this bullish? Well, the Federal Reserve is not lowering interest rates because they've won the war against inflation. And I will caveat this with CPI is a terrible way to measure inflation. It drastically understates how much the currency is being debased. Nevertheless, it is directionally accurate in terms of the second derivative, which is the rate of change of inflation. So that's kind of a mouthful, right? But inflation is the first derivative of prices. Inflation measures the rate of change of prices. The rate of change of the rate of change, CPI can be directionally accurate in terms of reflecting that. Moreover, It's relevant to us as investors because this is what the Federal Reserve uses to make policy. Despite all of the flaws of this metric, this is what they use. So if we're trying to put ourselves in the shoes of the Federal Reserve, we should be looking at the same things they're looking at. And they did not win the war against inflation, right? Because their objective is 2% CPI. We didn't get that. We're at 3% for September, and they're already just trying to push that under the rug, right? The reason they're cutting interest rates has nothing to do with, oh, we won against inflation. Their target, they're still 50% off. They want to devalue your currency by 2% a year. They're doing it by 3%. That's a 50% increase relative. So they didn't win against inflation. So why are they cutting rates? Does why is he so insistent on the Federal Reserve lowering rates? Well, there is a tight liquidity situation in the market right about now. You can see the federal funds rate has been relatively elevated for some time now. For all of the 2010s, it was near zero. They started to raise interest rates in 2018. That put some pressure on the markets, which resulted in them having to drop interest rates under the guise of a pandemic. Nevertheless, they cut interest rates. Similar situation. They hiked interest rates at the fastest rate on record. This did not immediately cause a recession. It did cause liquidity problems, and we saw evidence of this in 2023 with the banking crisis. And we're seeing evidence of it again now with the use of the overnight repurchase agreement. So, the repo market, the more this is tapped into, especially at scale, we know that there are certain areas of the financial sector are facing liquidity challenges. We've seen this facility be tapped pretty aggressively during October. So that's a sign, hey, things are a little tight right now, a lot of borrowing going on, and so let's get rates down. When we look at the Fed's balance sheet, Bitcoin has performed exceedingly well over the past few years, despite the Fed balance sheet tapering down, but despite quantitative tightening. The reason being is kind of twofold. First, liquidity was increasing in spite of this because of what's called fiscal dominance. If you're familiar with this, it's the idea that Congress is spending so much, there's so much deficit spending at the federal level, it outweighs the quantitative tightening from the central bank in terms of the impact on the liquid money supply or the M2 money supply. So the Federal Reserve has been trying to tighten things in, but the deficits are so large. The United States is in so much debt. They're spending so much on interest payments, Social Security, Medicare, foreign aid, and all that sort of thing that the amount of currency in the system is just outpacing any attempt by the central bank to rein that in, which is why we've continued to have currency debasement and relatively high inflation over the past couple years, in spite of the elevated interest rates from the Fed. So, next, we want to look at the supply side, right? So, demand side, things are looking like they're about to tick up. We're going to switch from a regime of quantitative tightening to a regime of quantitative easing. Now let's look at the supply side because who is selling their Bitcoin at 100K? And spoiler alert, it's not BlackRock. It's not the smart money, as I alluded to at the beginning of this video. When we look at the ETF holdings, they're only down about 2% from their peak. Many investors using the ETFs are susceptible to the same forms of market psychology that retail investors are plagued by. They're fearful at bottoms and they're euphoric at tops, but not all of them. And what we've seen over the past month is a very telling sign of who is selling. And we'll unpack that a little bit more later in the video. But the high level is it's not the people using the ETFs. Over the past month, their holdings are down about 30,000 Bitcoin from the peak back in early October when the Bitcoin price peaked. But directionally, over the long term, the ETFs just continue to be this vehicle that is absorbing Bitcoin, buying incessantly. You can see even during the summer consolidation of 2024, ETF holdings were up and to the right. They tapered off a little bit during the tariff tantrum of Q2 of 2025, but over the long term, it's been up and to the right, and this little blip will ultimately be no different. So if they're not selling that much Bitcoin, which 30,000 Bitcoin would be a ton to individuals like you or myself, but for the aggregate of all of the ETFs, that's hardly anything. It's only 2.2% of their entire holdings. So they're not selling. In fact, they are buying. And this tweet from Eric Balkunas, who is the ETF goat in the Bitcoin and broader financial world, really sums it up. And he's looking at the holdings of Harvard's endowment fund. And IBIT, the BlackRock Bitcoin ETF, they hold almost $500 million worth of IBIT. And in Q3 alone, they increased their holdings by more than $300 million. So Harvard is buying Bitcoin right now, and you think you should sell Bitcoin because of this idea of the 4-year cycles and because retail investors think they're smarter than the market and they think they know better and they can time this, but Harvard's just buying incessantly. They are pretty price agnostic, as it would seem. And generally, this is true of anyone using the Bitcoin ETF, which we know is predominantly institutions. So I think this is a very, very telling tweet. And if you or a piece of data rather, and I would not be fading this personally. And what's the action item here? Well, the action item is don't relent from accumulating Bitcoin. Everyone is going to be fearful and panicky at the bottom and euphoric at the top. And people love to point out Bitcoin's seemingly subpar returns over the past few years. This idea of diminishing returns. We're too late to Bitcoin. We missed the boat. If you measure Bitcoin's price from the 2021 peak to now, it's up about 45%, which not that great relative to what people have come to expect from Bitcoin. And in the same time, gold is up almost 120%. People love to show the price chart of Bitcoin versus gold during this time horizon. Hey, Bitcoin's never broken its gold denominated all-time high. But I think this really misses a key point in terms of practical application for investors. People don't just buy once and forget about it. Investors, we are active in that we continuously accumulate assets over time, right? You don't want to just buy once and forget about it. Every time you get a paycheck or income of any sorts, you want to be investing some portion of that income, also known as a dollar cost average strategy. And when you measure Bitcoin's returns with a DCA strategy, rather than, cherry picking a date from the bull market euphoric top of 2021 to now, Bitcoin has drastically outperformed equities and gold. So a DCA, a $100 weekly DCA over the past 4 years, with Bitcoin has returned 147%, with gold 86%, and with the S&P 500 about 40%. So Bitcoin drastically outperforming these other assets when you accumulate over time. Why is that? Because the volatility is your friend. It works to your advantage. You're buying Bitcoin on these dips, riding that price appreciation off the bottoms. And this is one of those times right now. You do not get these returns from the bottom segment of this chart, the DCA returns, if you're not constantly accumulating Bitcoin. If you're panicking, trying to time things, you're going to miss the bottom. And that's where the majority of the gains come from. If you're only buying the top, you're not going to get as impressive of returns as if you're always accumulating Bitcoin. So what I would leave, in terms of parting words, stack Bitcoin every day. Stop falling for the panic. We're not smarter than the market. Everybody knows about the 4-year cycle at this point. There's little to no impact of the halving in terms of the actual supply and demand dynamics with Bitcoin. So just accumulate every day. This is what the institutional investors are doing. The market's fundamentally different. And one of the best ways to accumulate Bitcoin every day is by mining Bitcoin. You're able to dollar cost average at a discount while also getting a 100% deduction on the hardware. That's right, a 100% write off thanks to new guidelines from the big, beautiful bill. If you spend $100,000 on mining hardware, you can write off $100,000 of W 2 or business income. Meanwhile, these miners, when you host them with Blockware, you don't have to handle any of the setup or maintenance yourself. We handle all of that, and you get to stack Bitcoin every single day at a discount. For more information, go to mining.blockwaresolutions.com/info. You can fill out the form there, schedule a free consultation with a member of our team, and we can tell you more about Blockware, more about Bitcoin mining, and answer any questions you may have. Again, that's mining.blockwaresolutions.com/info. Make sure to like the video, share it with a friend, subscribe to the channel, and leave a comment down below telling me if you agree or disagree with what I've shown you here today. Thanks for watching.